You are listening to The Vocal Technologist. Spoken tech for your ears.
Welcome to the Deep Dive, and specifically, Founder Fridays. Today, we're cutting through the noise for you and diving into some critical insights to really sharpen your founder instincts.
That's right. We're aiming to pull out the key nuggets from market trends, what's happening with acquisitions, battle-tested strategies.
Sure.
Basically give you a clearer picture of what's going on and why it actually matters for your startup.
Yeah, we'll hit on IPO surprises, big AI moves, how some startups get to millions with tiny teams, even, the real deal on sales pilots.
Yeah.
So let's jump in. Okay, first up, AI. It just keeps moving, doesn't it? We saw Meta grab that AI audio startup, WaveForms. Big boost for their Superintelligence Labs.
Mm-hmm. And they're focusing on pretty advanced stuff like the speech Turing Test, making AI sound totally human, and even emotional general intelligence. Can AI feel, or at least seem like it?
Wow. But then you've got OpenAI.
Right. And what's fascinating there, and this is key for you listening, is how users push back. OpenAI had to bring back GPT-4o because people actually missed its personality compared to the newer model.
So people prefer the feel of the older one.
Exactly. Sam Altman acknowledged they need to work on performance concerns people have. So you see this tension. Cutting-edge tech versus what users actually connect with. A big lesson if you're building anything AI-related.
That human connection point is huge.
Yeah.
Speaking of things maybe not being quite what they seem, IPOs. Figma stock pops 250% day one. Looks incredible.
It looks amazing, yes. But here's the thing you need to understand. That was mostly artificial scarcity. The investment banks kept the shares available to trade incredibly small, like maybe 3%.
Just 3%.
Yeah, tiny. It creates those huge headlines, rewards their top clients. But then often, the stock tanks once more shares hit the market. Figma dropped 50% pretty fast.
Ouch. So that initial pop isn't necessarily real value.
Not sustainable value, no. It's
Yeah.
a bit of a show. Chasing that can distract you from, building something solid long term.
Okay, so if the public markets can be illusory, where's the real growth? I was reading about Vitalize Care. Millions in ARR. Tiny team, fewer than 15 people.
Incredible story. And their secret, extreme customer proximity. I mean, the founders literally slept in hospitals for 8 months.
Wow, really? For 8 months?
Yeah, not just a gimmick. It made them realize nurses weren't stressed about needing therapy apps. They were drowning in staffing nightmares. So they pivoted the entire product based on that deep insight.
So they scrapped their original idea.
Completely. Sold the new concept with just Figma mock-ups initially. It shows most startups fail because they build what they think customers want, not what's actually needed. Their engineers still go to hospitals regularly. That immersion is everything.
That's powerful. Okay, so you found the real need. How do you make sure your message lands? Let's talk message market fit.
Right. Super important. To test it effectively, don't just tweak words. Run, say, 2 or 3 really different angles across your channels.
Different value propositions.
Exactly. Aim for maybe 8, 12 qualified leads for each version over a couple of weeks. Then sit down with sales. What worked, what didn't. If one angle gets you a 15% or more jump in conversions, boom, that's your signal.
So message market fit means buyers just get it faster.
Pretty much. They understand your value proposition almost instantly. Less explaining needed. Higher response rates, it just clicks.
Okay, message clicks, leads come in. Then comes a pilot question. Chief procurement officers might say no pilots is a red flag, but you're saying the best sales teams actually avoid them.
They default to no pilots, yeah. They make the buyer pay to prove they're serious, skin in the game.
Makes sense. But sometimes you have to offer one, right?
Sometimes, if you must, structure it smartly. Put in continuation clauses, like it auto-converts to paid in 120 days unless they actively cancel. CJ Edmonds at Conversion Logics does this well. Often, a pilot request isn't just about features.
What else is it about?
It's testing if you're enterprise grade. Can you integrate, handle their processes, deliver reliably? It should really be your last resort, not your first offer.
Got it. Okay, zooming out a bit. The broader financial picture. This private market trap. $13 trillion stuck.
Yeah, it's a huge amount. And for your team, startup stock can feel like monopoly money if there's no way to cash it out, makes attracting and keeping top people harder.
And that ties into debt ratios affecting deals now.
Directly. Debt to EBITDA ratios are way down for 2025 deals. Back in 2021, maybe 7.5 times debt was common for a private equity deal. Now, it's closer to 5 times.
With less leverage available for PE firms.
Right. which means they're looking more at taking struggling public companies private. Those take privates like PagerDuty because they're cheaper and easier to finance at those lower debt levels compared to buying expensive private companies.
Interesting shift. And briefly, you mentioned European founders tending to retire earlier compared to the U.S.
Yeah, there's a cultural difference there. In the U.S., there's often this push to keep building, create the next thing. In Europe, sometimes founders exit and that's it.
How does that impact things?
Well, it could mean Europe potentially falls behind on innovation cycles if successful founders aren't reinvesting their experience and capital into new ventures as consistently. Something to think about depending on where you're building or hiring. It's fascinating how all these pieces connect. AI's human side, IPO smoke and mirrors, deep customer work, deal financing shifts. It all shapes the world you operate in as a founder.
Absolutely. We've seen the flashy IPO pops aren't always real, how crucial just listening to customers is, and how the money landscape is changing. So thinking about that liquidity trap, the debt changes. What does this really mean for the actual tangible value of your company's stock? And maybe more importantly, for keeping your team motivated long term?
It really pushes you to consider, are you building for that quick headline, that artificial pop? Or are we building fundamental, durable value that can weather these market shifts and truly reward everyone involved, your team, your investors, yourself down the road? Something to really chew on.
Spoken Tech, for your ears.